And welcome back to another episode of the Retire Early, Retire Now podcast. I'm your host, Hunter Kelly, certified financial planner. And today we're diving into 5 proactive tax planning strategies specifically designed for high income earners. Tax planning should never be an end of the year scramble or merely part of the preparation process. Instead, it should be viewed as a year round process. As I always say, taxes are going to be your largest expense over your lifetime, so it's very important to be strategic throughout the year. When tax planning is viewed as a year-end scramble or overlooked until it's time to file, opportunities can easily be missed. So this means you're leaving money on the table or worse, paying the IRS a tip. So a systematic year-long approach ensures that you can consistently identify and leverage opportunities and hopefully substantially lower your tax burden over time. But before we dive in, let's go ahead and hear from you. If you're watching on YouTube, comment below what's your favorite tax saving strategy? What's the one that's most effective or maybe even challenging to implement? I would love to hear from you and hear your experience. And if you're listening on your favorite podcasting app, please leave a 5-star review or share this with a friend. Now let's get started to explore 5 actionable strategies tailored for high income earners, hopefully like you. Now, the first one should be the easiest one to implement, but it can be very important, and that is front load those retirement contributions. So we want to maximize your retirement contributions. Likely, if you're a high income earner, just contributing to a retirement account alone is not going to be enough to save for retirement. So let's go ahead and get those dollars in there so that we have more time in the market, right? So your 401ks, your 403bs, your SEPs, maybe solo Ks early in the year so that we can get that money in there and get it investing, get it working for you, especially a year like this year where we've had a little bit of a pullback and some volatility in the market. Great time to get into the market. Not that I'm about timing the market, but it is a bit of an opportunity. So let's go ahead and try to front load those retirement contributions. Now, one of the things that we want to determine there is should it be pre-taxed or Roth, and that's going to be based off your independent situation or individual situation. And I've made a podcast episode about that, but we want to determine should we do Roth or pre-taxed. The other thing is make sure your cash flow allows for it, right? If you're shoving $23,000 or more into this account within a few handful of months, then your cash flow may be crunched. So maybe you need to spread it out a little bit longer. The other thing you want to consider is that employer match. Sometimes, or most of the time, if you're receiving a match, you're going to want to defer this contribution over the entire year to continue to receive that match, because they will not give you the match unless you're deferring in that payroll period. So maybe you front load a little bit up front, but making sure that you have at least enough to get the match throughout the year. You don't want to miss that free money, right? And so again, if the match is not something that you are worried about because maybe you don't receive one, then go ahead and front load that up if your cash flow allows for it. Again, because more time in the market to allow those dollars to start working for you. Now, let's hop into strategy number 2, backdoor Roth IRA planning. This is a common and ideal strategy for high income earners because, again, you likely make too much money to directly contribute to a Roth IRA. So this would involve making a non-deductible contribution to your traditional IRA and then hopefully immediately converting that to a Roth IRA. I prefer to do these early in the year. This simplifies your tax tracking and reduces your complexity. And the one thing you want to be mindful of is the pro rata rule, meaning you may have to owe a little bit of taxes if you have any traditional or pre-tax money in your IRAs. So we want to make sure that that money is out of our IRAs and we only have that non-deductible contribution or those after-tax dollars so that when we convert, we don't owe any taxes and our tax complexity is low, right? Or complexity. I don't know why I keep saying complexity. So complexity is low. If we do have a balance in our IRA, we'll owe a little bit more taxes because the IRS rule says that we would have to convert some of that pre-tax dollars. But that's not the worst part about the rule. The worst part about the rule is now you have to track that every year until you get those dollars out of your IRA. And so that can be a bit of a pain moving forward. So we want to make sure that all of the traditional or pre-tax dollars are out, and you can easily do that by maybe rolling that balance into a 401k plan and then giving you a clean slate for the backdoor Roth planning opportunities. Or maybe you go ahead and just convert it because it's a small balance, knowing that you're going to owe a little bit of taxes, but moving forward, you don't have to worry about it, and it's going to be worth the amount of taxes that you're paying at this point. And then the last point here is that if you are married, consider doing this for your spouse as well. Maybe your spouse doesn't work, or maybe they do work, but they just have a 401k that they've been contributing to, whatever that situation is. But that allows you to double up that backdoor Roth opportunity there, whether that's the $7,000 limit if you're under the age 50 or above to $8,000. Just consider that as well. Strategy number 3. This is often overlooked. And when I do tax return reviews, I often see either underpayment penalties or large returns, right? And so we want to review and adjust your withholdings for whatever your employer is withholding, or adjust your estimated tax payments, because we don't want to underpay because we get penalized for that. We also don't want to give the IRS a loan. So it is essential to just review this every year, especially if your income is fluctuating from year to year because of bonuses or because of how you're paid, whether that's through commissions, or maybe you started some sort of consulting side of your income where you're getting 1099 income now, whatever that may be. And so we want to adjust our withholding or adjust our estimated payments accordingly. And so the way we do that is we start to understand what our safe harbor number is, right? That's going to be based off your prior year or your current year tax liability. Obviously, seek a financial planner that does tax planning or a tax professional to help you forecast those numbers. But then that will give you a great plan for either adjusting your withholding or your quarterly payments moving forward, so that, again, you're finding that even balance of withholding too much or withholding not enough. The idea is that you receive $0 back and you don't have to pay anything the following tax year. Again, we don't want to give the IRS a free loan. We don't want to be penalized for underpayments. Number 4, start tracking potential tax loss harvesting opportunities. It's March. I wish I would have done this knowing that we were going to have a volatile market. So I wish I would have done this in January, knowing kind of what we've had in the market lately. But this has been a great opportunity to potentially capture some losses within your investment accounts, especially if you've just kind of dumped some cash in recently. The market has pulled back quite a bit, right? And so this is a great opportunity to go, okay, I have some big losers here. I can sell those, maybe get into something similar, or hold it in cash for 30, 31 days to avoid those wash sale rules. And then now I can capture these losses, and moving forward, I can either take a deduction of $3,000 off my ordinary income, or I can save these for later. So as I sell later on and potentially have capital gains, I can offset those gains with these losses. So years like this are great to capture losses in volatile markets, right? So we want to be looking for those opportunities, and this should be a daily thing. That's what we do here at Palm Valley Wealth Management. We have trading systems in place that is constantly looking for these opportunities, especially in years like this, so that we can capture those losses and mitigate those taxes in those brokerage accounts, because that's going to be the biggest drag on those investment returns in those types of accounts is taxes. So if we can avoid taxes by capturing some losses up front, then later on down the road, we may have $60,000, $70,000, hundreds of thousands of dollars of losses over time to be able to use to offset gains of either gains inside this particular account or maybe a business that we sell later on down the road. Detailed all of this in my episode called Direct Index Investing. So check that out. That was a few weeks ago. But this is a great time to check for losses, especially in volatile markets. Number 4, if you're charitably inclined, one of the things that you can do, especially early on, is utilize either a donor advised fund or bunching your charitable giving, right? So donor advised fund, for the quick and easy example, is if I know I'm giving $10,000 a year for the foreseeable future to my said charity, I can go ahead, I can create this donor advised fund, I can contribute $100,000, take that tax deduction up front, and then gradually disperse those funds to the charity over a 10-year period. This allows me to reduce my income significantly, and I can do things like charitable giving, not charitable giving, but Roth conversions or other types of distributions where I have taxable income coming in and save on taxes. The other strategy is bunching my charitable giving. So with the standard deduction being so high after 2018, a lot of times people will bunch their charitable giving into every other year so that one year they take the standard deduction, which is just under $30,000 if you're married. And then the following year they'll give more so that they can itemize and deduct more than that standard deduction off of their taxes, right? So these are two strategies that you can kind of utilize if you are charitably inclined. And so again, this is a more complex strategy. So please seek a financial advisor or tax planner that is very well versed in these planning strategies, because again, you want to make sure that you're abiding by the IRS guidelines. Surprise, we have a bonus tip, and that is income shifting or family gifting strategies. So if you own a business, sometimes you can employ family members such as children for legitimate business needs, and you can shift that income to them because you can pay them into lower tax brackets. You could also allow them to contribute to things like Roth IRAs. So get them to work. Obviously, it teaches them some valuable lessons about hard work and running maybe a family business and things of that nature, but then allows them to start learning how money works. They can start saving for their retirement, things of that nature. So that's just a bonus tip that we'll talk about today. 5 things that we talked about today: front loading those retirement contributions, utilizing your backdoor Roth IRA contributions, adjusting your withholdings or estimated taxes, taking advantages of tax loss harvesting opportunities, and maximizing those charitable deductions through donor advised funds or bunching those charitable contributions. And so if these are strategies that you're interested in, but you're like, I do not know how to implement these are things that I help clients with every single year. Go to my website, palmvalleywm.com. You can schedule a free call with me, and we can talk about your situation and hopefully get someone that can help you, whether that's me or maybe a tax advisor, CPA, for your tax planning needs. Again, tax planning is not an end of the year scramble. It is a year-round planning opportunity. So keep that in mind. And again, if you're watching on YouTube, go ahead and subscribe to my channel and like this video. If you're listening on your favorite podcasting app, leave a 5-star review and share it with a friend. And as always, thanks for listening, and we'll see you in the next one. This podcast is for educational purposes only. It is not meant to be tax advice, investing advice, or financial planning advice. Do not make decisions solely based on this podcast alone. Please seek a tax, financial, legal, or insurance professional when considering your own specific situation.